Hey buddy, Boris, that's from BK Force. Welcome to our Forex Weekly Technicals for 10/27/10/31/2014. Where are the trades? Well, an interesting week this week, but a very much consolidated week after a really, really wild and volatile week last week. Something that I had talked about at the end of last week and suggested that probably we're going to have much tighter, much more consolidated markets. And it's exactly what we got here. We dropped off the 28, which was the big resist level. And then after that, the 26 became support. And we essentially, the inside range for here in the euro dollar is 28 to 26, with the outer range being 29 to 25, and we're sort of probing the lower end of it. The last couple of days, 26 support has really held. We have IFO on Monday. We'll see if that provides a modicum of support to push the euro a little bit higher. But overall, I think the natural tone of the market sort of is that if the economic data does not deepen and worsen, and we're not going to see more contractionary indicators out of the eurozone, perhaps we may be near a bottom here. And in fact, if we form a bottom over here, it looks actually mildly bullish on the near-term basis, because we would have a higher low here and suggest that we could make a move back up towards the 28s, perhaps even the 29s. There are a lot of orders, sell orders at a 29 handle, and there's a lot of recommendations to short the euro into the 29.30 zone, which probably makes a lot of sense because you're going to have a lot of resistance at this level. But for now, we're still far away from these levels, and the potential for a rally into that area exists very much into next week if we can get any kind of positive traction out of the euro. Yen slipped a little bit sort of pre the close and came right back up. We're still holding around the 108.14. Data was not very supportive. New home sales did not do as well as we had hoped. But overall, U.S. data still remains relatively positive. Although we don't really get any kind of big resolution to this until the week following, not next week, but the week following. Next week is still going to be just a very, very mild week with durable goods, not really any kind of major event risk on the table. So we'll have to see if we get any kind of further support. But for now, it seems like this 108.50 is going to be pretty much a sticky area for us. This V-shaped recovery, very bullish, very indicative of the V-shaped recovery in the equity market, but we may be now coming up against this 108, 109 zone, which is going to be a lot more problematic than thought. Pound dollar bouncing off the 60s, actually recovering a little bit better than expected. GDP numbers today were okay. Next week is going to bring us a little bit more UK data, but of course the real big data set is going to come in the front week of the week after that, the front week of November, as we'll get the PMI data out of UK to get a sense of how the readings are going over there. Net story in UK, I think, is still very much that the BOE remains on the sidelines. There's no first to hike story. There's little really impetus to make the cable really trade higher. Technically, you essentially have a series of lower highs, but you do also have higher lows over here. So it's kind of a diamond formation that could resolve itself, sort of a tightening of volatility from this end to this end. That could resolve itself either way. For now, this 59 still remains to be a relatively solid support, but the 62 remains to be a very, very strong overhead resistance. So until either one of them is broken, I would say it's a trade to stay away from, because it really doesn't offer any kind of meaningful upside or downside moves. Aussie dollar continues to look relatively okay, but still this 88 is the really big oscillation level, and then it's basically an 87-88 trade with 87-89 trade with 88 the equilibrium value. And it's really actually amazing that after so many volatile moves in the Aussie dollar, we now find ourselves in a month of incredibly low volatility. I mean, we're just very, very contained in the Aussie on both sides of the trade. For directional traders, this is really going to be a nightmare of a trade to hold. Perhaps the much better thing here, just as it is in cable, is just to simply stand down and let the price resolve itself one way or the other before looking for any potential possibilities. In CAD, the trade actually improved a little bit. The Canadian dollar, after spiking out above through the 113s, has now, given the fact that the BOC has taken out accommodative out of its language and started a little bit more neutral, has certainly taken on a much better bid tone, although this 112 level now remains very strong support for dollar CAD. However, the probing of this 1, 2, 3, 4, 5 times of the dollar 12 level suggests that the next time or the time after that, the break below 112 could really open up a move all the way down to 110. So there's a potential here for further looning strength as next week continues. Now, lastly but not leastly, we have the Kiwi. Kiwi does have a lot of very important data this week. Let me just, where's my Kiwi here? Here's my Kiwi, sorry. Let me pull it up. the Kiwi story is going to be very interesting because we have the RBNZ statement. Now, the RBNZ has been notoriously dovish in its assessment, but it'll be interesting to see if they signal any kind of potential future hikes. In other words, if they sort of continue to state that the Kiwi dollar is overvalued, but that there is perhaps further need for tightening down the road. Even if they assume even a modest hawkish posture, a lot of this weakness in the Kiwi could be reversed very, very quickly. So volatility could definitely be a big move here. On the other hand, if they're dovish, but not to the point where they're going to threaten any further rate cuts, you could have a knee-jerk reaction to the downside. Another test, this 77 level is a very, very important level, and certainly could get tested again. But to break it, you really would have to have a meaningful, fresh piece of news that would threaten further intervention, or maybe even promise further intervention in order for the pair to really break down below the 77. Given the fact that the yield is still pretty high, the data out of New Zealand remains relatively good, the test of the 77 should be pretty much a buy rather than a sell, unless we have radically different information that could change things around. Now, on the yen crosses, what's interesting, I think, is that this whole week the yen crosses have actually been a relatively good performer. Again, and they're very indicative of the V shape that you're seeing in the equity markets. Here's the Aussie yen, here's Euro yen, really performing in a relatively decent bottoming. What's going to be interesting to see next week, in many ways, is how much of this equity risk-on rally we're going to have continue, because the yen crosses in many ways are kind of at a key level here and could, if they break higher, create enough momentum to really, for example, take us to 38 in Euro yen, maybe even 38.50. Take us, let me just look at the pound yen here for just a second. Take us all the way through the 74.75 level in pound yen. And essentially, this whole V shape could turn into a more powerful, extensive rally if it does extend further. On the other hand, if we start to falter this 108 level in dollar yen, a lot of these yen crosses are now becoming very vulnerable to a turn down into a lower end of the range. So in other words, this is all at the top end of the ranges. So in many ways, I think one of the more interesting trades next week is going to be to watch the yen crosses and seeing if we're getting an exhaustion move here or a continuation move, and trade accordingly depending on how the price action goes. Wishing you guys the best of luck and the best of trading. This is Boris Schlossberg. Over now.